morning.
Let's get straight to it. The latest HSBC recommendation here, take profits in financials and materials. Tell us why.
I think in the second half of the year, the narrative in the markets is going to change. We're talking about inflation numbers now. I believe Korea came through with some high inflation numbers recently. So we're in that wave of inflation numbers coming through. We think it's going to peter out in the second half of the year. And that probably means that the upward rise that we've seen in bond yields is going to come to a halt as well. And that's been the driver of financials. So we think in the second half of the year, financials won't perform as well. So we're looking at rotating out of that sector, to taking it a notch down.
And you like industrials?
Yeah, it's, industrials to a certain extent, valuations are a bit more reasonable. But I think what it really is you're going to have some stimulus packages across the world that are going to be put in place. There are all kinds of other things going on in industrials, from automation and robotics and stuff like that. So it's a sector that we like. We think that's something to look for.
At what point do you think the market starts looking back at tech, Harold? In other words, my question would be, I guess, in what ways do you think market conditions might change, and when might they change to become more, I guess, hospitable to growth in tech?
So the problem with tech is that there are some interesting stories in tech, but they're all very well priced in, right? So we know about chip shortages, EVs, all kinds of other stuff. So within tech, valuations are high, so you've got to be extremely selective. What might help tech if in the second half of the year, as I said early on, if we're going to go over this hump in inflation numbers that are going to come through over the summer, and we see that things actually, inflation numbers start to drift a little bit lower again, in the second half of the year, the interest rates and bond yields start to drift a little bit lower as well. That could actually be supportive to tech in general. So it might well be that in the second half of the year, there's going to be a little bit more support for that particular sector. We'll see how that's going to work out. But for the moment,
Harold,
it's quite an expensive sector. Tough to really put a lot of money into it.
Absolutely. You make a very good point. That then takes us, I guess, partly to one of your underweights, which is Taiwan. And I have to say, there's so much momentum in that market, Harold. Why get out of the way?
Yeah, no, it has performed much better than we anticipated. I'll be very honest with that. I don't deny that there is a lot of momentum. There's a lot of things going well in Taiwan. You get the chip shortages going through. So there's a lot of stuff at play. We just found it expensive, and we tried to look in markets that are a little bit more cheaper, that would benefit from these lower bond yields in the second half of this year as well, such as, say, Indonesia or parts of ASEAN. So yeah, that hasn't really worked out yet. But we're a little bit cautious on those valuations. That's really the issue.
India, the market's held up. I know you're underweight on that. You're underweight because of the virus or something else?
We're underweight basically. When we went underweight, we didn't know that the second wave was coming. But the valuations in India were so high that any good news would not mean that the market would go higher, but any bad news could mean a bit of downside. And that's why we went underweight at the time. It turned out that bad news came in this massive COVID wave that is coming through India at the moment. Very tragic. But yeah, it was just an expensive market as well. So we just wanted to be careful with it.
And Harold, let's talk about data. You mentioned South Korean GDP also out these last 12 hours or so, I think. Hong Kong GDP. Now, that growth picture hasn't really come out as far as, I guess, the earnings and the earnings expectations are concerned. I'm looking at MSCI Hong Kong. But you like Hong Kong. Is now the time to build exposure to Hong Kong?
We think so. And that's not really because of the GDP numbers. GDP and earnings growth. Earnings growth is important for equities, right? And the relationship between earnings growth and GDP is not always a very strong one. So you got to be a little bit careful by reading too much into GDP numbers. But irrespective of that, Hong Kong seems to be bouncing back. A lot of the earnings actually generated in Hong Kong are Chinese earnings, and that not just the Chinese companies, but Hong Kong companies that have substantial operations in China. One of the leading Hong Kong retailers in jewelry has got about 70-80% of the business coming in China. So that's something really important to look for as well. But again, Hong Kong compared to China itself is rather cheap, actually. It looks quite, doesn't look too expensive. So it's something that we favored for that particular reason.
Harold, you've done your team has done a lot of research on changing demographics, older demographics in some parts of Asia, and some parts obviously not the case there. What are the key takeaways here?
There's a couple of important takeaways there. First of all, I would say we all know that Asia is aging. People are worried about that and think that aging is something really bad. In the past, we said actually it's not the case. Older people tend to be wealthier than younger people. So there's a wealth effect that's coming through as well. We see this in markets now. There is an incredible increase in retail participation in nearly all stock markets across the region, from Korea to Indonesia. In some markets, such as Indonesia, for the first time, we see that retailers are really coming through in force. In Korea, they've overtaken the institutions that invest in these places, the pension funds and the mutual funds, etc. I think that is partially a reflection of aging demographics. So that's one of the key takeaways. There are plenty of other ones, but another one I would quickly highlight here is that there's this rise of Chinese empty nesters. Chinese are about to say close to 40. Over the next couple of years, a lot of them see their children leave. They have a dual income situation. So you get what in the US was called dinkies, dual income, no kids in China. And those are households that can actually spend well and consume. And they get some money to burn, you could say. So that's something, I think that's going to be actually the key driver of the consumer sector over the course of the next 5 to 10 years even.
It really makes you wonder, Harold, whether cruises might be the next big thing. Obviously, I'm just, that's spoken a little bit of a joke there. But that being said, final question on China population here. And something that's constantly been brought up is that China is aging at a time in its development that is relatively early compared to what we saw, say, in Western countries as well. Why is that not a bad thing?
It does not have to turn out to be a bad thing. It depends a bit on how China is going to react to all of this. But it is aging. It is an early stage of development. But as I said, there are other factors that play an important role here. For example, households in China are much smaller than elsewhere in the world. You had a one-child policy, right? But you can imagine if you have an income and you get to share it with your wife and your child, so with the three of you, it's a very different situation than if you got 2 children. And if your wife also works, you get 2 incomes and 1 child. Well, that's a very different kind of situation than if your wife doesn't work and you got 3 children to take care of, which is the case in some of the other countries. So there are all kinds of other dynamics at play as well. Smaller households, high female labor participation rates in China, and that might mean that the whole pattern of aging is going to turn out to be quite differently. And maybe therefore China can actually benefit from that aging, or benefit is a big word, but yeah, it's very different dynamics than what we've seen elsewhere in the world in the past.